me introduce my two colleagues. So I'm, first of all, Rebecca Gabriel, business consultant with Vitality Southeast, and my colleague Gary King, who on my screen is to the right of me, but might not be for you, head of protection specialists, loves a technical question. So please feel free to fire away with the tricky questions. And Mark Savage, who, like me, is a business consultant with the Southeast. So yeah,
Good.
thank you very much for joining us all. So we're not going to sit here and discuss, what may or may not happen on the 26th. I'm sure you've probably got lots of, concerned clients asking you questions, and hoping that you've got some kind of silver bullet, which of course, sadly, we don't. But one thing that we do have, which isn't going to change, is whole of life insurance, which of course has been around for ages, but we've seen a huge uptick in the use of this as a financial planning tool since the last budget. So, Gary and Mark are going to walk you through Vitality's proposition specifically. So, where we stand out or maybe offer something a bit different. Wouldn't be Vitality if we didn't offer something a little bit different or over and above the rest. And then Mark is going to share some insights with you as to what others are using this for. So, how other financial advisors are utilizing whole of life to discuss things with their clients and using that as a tool alongside everything else that they're doing currently. So the session's only going to be about 30 minutes or so, and then 10 minutes for questions. My only ask of all of you, if I may, is that if a question pops into your head at any point, fire it straight into the chat, please. Because even if you sit there thinking, oh, it seems like a daft question, or maybe they'll cover it off in the next 5, 10 minutes, assume that we won't, and nothing is a daft question. There might be somebody else on the call who actually would really benefit from whatever it is that you were going to ask. So I will pass over to Gary King.
Thanks, Rebecca. And yes, good morning, everybody. Thank you for joining us today. So I think for me, I really just want to sort of set the scene as to sort of where we are in this space. And as Becky mentioned, I think since the last budget, we've seen a 400% increase in IHT-related whole-of-life policies being written. So obviously, I'm sure many of you are very comfortable with this, and obviously it's something that we're having more and more discussions about. So obviously, just to really kind of look at where we are from a market point of view, and also, of course, where this tends to be fitting a lot more, I suppose, as part of a sort of IHT mitigation strategy. Now, this, of course, is something that you'll all be familiar with. It's hit the press quite frequently over the last sort of 12 months. And of course, looking at this significant spike in the amount of IHT being paid. This, of course, has driven a lot of the conversations with clients. Of course, it's becoming more in the, I suppose, the public awareness. And I think it's one of those interesting opportunities now where, because the media has done such I suppose, a good job of highlighting that obviously more of us are going to need to consider paying an IHT bill. It's a rare time that you actually see clients probably coming to you more frequently with questions around this than we've ever seen before. So, interestingly, when we start to look at how those numbers have really started to ramp up in recent years, of course, these are not taking into account any of the changes that were announced in October. Of course, business property and agricultural relief not coming into play until April next year. And then, of course, pensions coming in 2026. So we've seen such a massive increase in the amount taken already. And of course, when we start to look at the average IHT bill, not only is that growing, but also more of us are expecting to need to worry about this. I think when Rachel Reeves sort of mentioned that those that have will be shouldering the burden of making up the deficit. I think she mentioned at the time only about 7% of estates were actually paying IHT. Now, obviously, that 7% is across the board. We're going to see that, obviously, for the guys on the call today, that is going to be a much, much higher percentage. But of course, that's only going to continue to increase. And certainly when we look at what's coming in the next budget, which we'll move on to in a second, this will again sort of double down on that need and I suppose that client concern that this is something they need to talk about. So I'm not going to go through in any detail the changes that we saw last year, but of course, again, those nil rate bands being frozen yet again. I think it's now 2009 since we last saw an increase in those bands, and of course, house prices and incomes and inflation have driven a larger number of people to be needing to sort of consider IHT planning, being pushed through those thresholds. We are, of course, going to see pensions coming in into the sort of purview of IHT as of April 2027, and then business and agricultural relief being reduced in its, I suppose, its efficacy as of April next year. But this has really led to a significant rise in the number of people that are worried, and it does again present us with a very unique opportunity to make sure that we are having these conversations with our clients, and certainly as we'll go through during this session, really highlight how whole of life can play a pivotal part of that plan. Because I certainly think when we talk about all the other things that we are typically using, these are potentially in the firing line for the November budget. Obviously, we've seen a marked increase in inquiries around gifting. Certainly, it doesn't. Maybe it's just my news feed, but it certainly seems to be. There's always a lot of questions around what happens if I gift my house, or what happens if I plan to give significant sums to my children. That certainly does seem to be very much on the horizon. Again, a lot of talk around what people can do with their tax-free cash. I was reading an article last week talking about the 40% increase in inquiries to advisors around that tax-free cash. Do they want to take it now? What do they intend to do with that? Will that option still be available post this budget? Then obviously we talk about sort of any caps on gifting, what that might look like. All of the plans that we've put in place over recent years, certainly when we talk about pensions being a very IHT friendly way of saving, that again might change. And it all really highlights to me that we have to be mindful of changes that either have been announced or might be announced. And I think again that whole of life presents a wonderful solution here, just for the fact that whatever tax IHT mitigation strategy we might be using, that might well change. And I just think the idea that we can turn around and suggest that, well, we're likely to need to have to pay an IHT bill. We can either gift, or we can take out an insurance policy to pay that IHT bill for you for a reasonable monthly premium, which obviously is what Mark's going to tackle in a moment. Because as mentioned, I just think when we look at all those other solutions that are available there, of course, the standard things as you would expect, obviously using your allowances, making gifts. But again, all of these things might well be part of that strategy. I always tend to look at that sort of gift standpoint, whether it's giving, obviously, large cash sums, or using loan, discounted gift trust, family trust, property trust, those sorts of things. It is all still sort of based on the fact that we are gifting away the things that we have worked hard for. And certainly for clients in that sort of ultra high net worth space, that's probably a very sensible solution. But I think for the sort of middle England sector of client banks, I look at myself, I'm certainly not high net worth by any stretch of the imagination, but I don't want to give away the things that I've worked hard to build during my lifetime through fear of having an IHT bill. I'd certainly rather, enjoy my retirement and spend that money that I've worked hard to save on that retirement. But of course, things happen that we can't plan for, and I would much rather have a solution that provides me with a financial sum to pay that IHT bill, rather than have to give it away just in case. So lots of options there, and I really do think that whole of life solution really does present us with a fantastic either alternative or even part of that plan, depending on your preference. And I think as well, for those of you that maybe haven't looked at whole of life for a few years, maybe you've looked at it previously and it seemed pretty expensive. Obviously, whole of life rates are incredibly closely linked to gilt rates. So actually, when we look at what has happened to premiums for whole of life policies, they have reduced significantly. I took a policy that we've recently written, compared it to one for a similar amount that had been written 5 years ago, and there's actually a 40% reduction in premiums today. So really key that we do have a look at that. Of course, we're all mindful, of course, that gilt rates might not stay where they are indefinitely. So certainly not wanting to kind of put the time is now sort of message out there, but it's certainly worth reconsidering that. If you've looked at pricing on whole of life before, you might be surprised at the value that these policies can offer in the long term, which again, Mark will touch on in a moment. So actually, what a good time to hand over to Mark to take a look at some of those.
Perfect. Thanks, Gary. So yeah, it's actually really quite this part that Gary just spoke about is really, really important. And actually, advisors that talk about this with clients actually will get high conversion rates into writing whole of life policies, as clients tend to push things down the line if they don't have to do it now. But when they hear about this side of things and how the premiums offered by insurers are linked to gilts, actually, that's making clients understand the importance of taking a policy now. So I'm going to first of all go through one of our tools that we have available that we will send out to all of you after this webinar today. But to illustrate it well, kind of need an example. So just to run through this quickly, we've got Liz and John, and they have an estate of £2 million. When we minus off their nil rate bands and resident nil rate bands, they effectively have £1 million worth of their estate that would be subject to IHT if they were to die today. Obviously, 40% of that is 400,000. And Liz and John, in this example, are 55 years old currently, so 56 next birthday. And we want to get a policy that will pay out £400,000 once they both die. And it needs to be a whole of life one because a term policy won't pay out if they live past the end of that term. So to get that quote, actually on standard pricing, so pricing that would never ever change, that is coming in at £348 a month. Quite interesting. When I kind of roll out that figure to some advisors, some will say, that's quite steep. But then conversely, I have some advisors who go, oh my goodness, I used to quote for this whole of life business, and that's considerably cheaper than what I remember. So, you know, there's two ends of the spectrum there, and that's coming from advisors, let alone clients. So actually, if we have a tool that can illustrate what this actually looks like in terms of value to them, that's quite a beneficial thing. So this is our Vitality Premium Calculator, and we will again send this out to you after today in the follow-up. But you can see here it's got different areas on the screen, and the pink boxes are ones that we can basically amend, and then the white boxes are things that have calculations built into the spreadsheet that are automatically done for us. So at the top, we'd obviously put in the client's names, and then we'd put in their genders, and then their current ages. And what this spreadsheet will do is it will then pull what their life expectancies are based on ONS statistics. So then it pulls in that the male life is expected to live to age 82 and female is expected to live to age 85. We can then put into the anticipated cost to the estate, the sum assured that we are quoting. So Liz and John had a £400,000 IHT liability, so we quote for that amount. Put in the monthly premium that we got, which was £348 a month. And what it will then do on the right-hand side is it will say the total estimated cost of premiums if they paid for that policy up until their life expectancies. So it will times the monthly premium by 12 to get the annual premium, and then times it by the number of years they're expected to live. And Life 2 is expected to live 30 more years. So that's how that calculation's been worked out. It then has that sentence just below, and it will say how many years it would take for the premiums paid to equal the sum assured. And actually, when we look at that, 96 years before they would pay in what the payout's going to be. That sounds quite good, especially when it's money that's within their estate. So the premiums they're paying would otherwise fall in their estate potentially. And then it gets paid out into a trust outside of their estate, so it won't be subject to any IHT. Sounds like quite a good thing. And I think it's safe to say we're not seeing people who are currently age 55 to live into age 151. That's obviously demonstrating that actually that looks quite good, but reality is we wouldn't expect those clients just to sit on that monthly premium and do nothing with it instead. They might go and do an investment, for example. So what it will do, it will then mimic the whole of life premium down into the investment section. So it does the £348, and then it invests it and grows it at whatever growth rate we put in. So I've put in 4% there, as that's probably what I hear advisors talk about as what they can, you know, near enough get for clients on a consistent basis, but you could go and change that to 5, 6, 7%, whatever you tell clients that you can achieve. And then it will work out if they live to their life expectancies, what that estimated investment value would be worth. So if they invested £348 a month, getting that growth rate in 30 years, that investment would be worth £242,000. However, if that has been done within their estate and not done with a bond using a trust or something like that, actually that's created an additional IHT liability of £97,000 in this example. So then the post IHT investment value is then £145,000. So then at the bottom, what it will do is it will tell us how they would be if they took out the whole of life versus doing the investment for the same amount of monthly premium. And it tells us they're over £250,000 better off if they take the whole of life plan. which is quite compelling. So quite a lot of advisors that I work with will actually use this to kind of create that value, because £340 could sound like a lot, but when you see it illustrated like this, suddenly it sounds much more affordable. So, couple key reasons why Vitality. First of all, indexation. So Gary alluded to the fact that more and more people are getting IHT, having IHT liabilities, and more people are having higher IHT liabilities. And that is because, exactly as Gary illustrated, nil rate bands have been frozen, yet people's incomes are going up, their investments are growing, their house prices are going up. So actually, it's quite common, unless clients are actively mitigating their IHT with other strategies such as gifting, their IHT liability will continue to rise. Therefore, having it on an index basis where it will be inflation proofed sounds like a good idea. When we do that with Vitality, we are uniquely positioned in the fact that we are the only provider that actually give a discount to have it on an index basis instead of level. So we actually price between 4 and 5% cheaper on all whole of life plans if it's indexed versus if it's done on a level basis. And that's great because actually the clients could have that discount, and then even if they don't accept the indexation increases, because they have complete flexibility each year whether to accept it or reject it, if they reject it 3 years in a row at any point, indexation is removed, but then they actually keep that discount. So you could argue do indexation even if the clients have no inclination to have that sum assured increase. But actually, it goes a step further. So consumer duty, one of the key elements is foreseeable harm. I would say foreseeable harm looks like in an IHT world, if you're recommending whole of life, that IHT liability goes up, but they have become uninsurable. So if it's done on a level basis for Liz and John, they've got 400,000, then they can never buy any more, but they could have both become uninsurable in the next year, so they can't buy anymore. If it was indexed and it was going through an anniversary today, they would be able to buy 5% more cover without any underwriting. So that's just delivering better outcomes, quite frankly. So, yeah, the Vitality discount for it, and it's better for the clients. It seems like a complete no-brainer. And actually, we pay a commission uplift to you guys as well for having it indexed instead of level. So that's the first one. And then the second one we've got on the right-hand side, which is Optimizer. So I'm sure you guys have all seen that on your sourcing, and it's a solution that we believe to be absolutely game-changing in the insurance industry, and actually it's something that is just being more and more widely used, but in the whole of life space, it is particularly powerful. So what Optimizers does effectively is it basically gives the same level of cover, but for up to 40% less initially. So if we just take a step back and think about how premiums work in the insurance world in general, it is incredibly common for all other types of insurance to have bad risk pricing, standard risk pricing, and then good risk pricing. And you can see here the examples, which is, if you were to have points on your license, you've got to pay more for your premium because ultimately you're probably more likely to have an accident or have to claim on your car insurance. If you've got no points, you pay the standard risk. But actually, if you've got a certain number of years of no claims, you get an extra discount. Or if you've, say, got a black box in your car and you take the black box car insurance premium, you actually then get it considerably cheaper up front. Same for home insurance. If you live in a high crime rate area, you have to pay a bit more. Then you've got the standard rate. But if you can answer certain questions during that application process for your home insurance, such as having a recognised house alarm, you actually will then get a discount on your premiums. So that's how premiums kind of work in the insurance world overall. But that isn't the same for protection. So, all insurers are quite happy to rate your clients or yourselves if you, say, have significant medical conditions, you are a smoker, or if you have a BMI of over a certain amount. Let's call it over 32 in this example. We then have standard rates, which is given to everyone else, as long as they don't have any significant medical conditions, they're a non-smoker, and their BMI is below 32. But we don't really have good risk in the protection world. And actually, it's quite interesting because all other industries, your clients can get rewarded if they are lower risk to an insurer, but it doesn't really happen with standard pricing. So if we think about that, reality is, let's take me. I am 30 years old. I could be 31.99 BMI, sit on the sofa every day and eat pizza. And actually, my chance of claiming is the top line there, where it says unfit, unhealthy, high risk, standard rates clients. Conversely, I could be someone who looks after my health, tries to eat well, tries to be active, tries to go on walks, that sort of thing, just look after myself. And actually, my chance of dying early and claiming is actually down here. And what the maths people do within the insurance industry, I've asked our actuary team, and they've absolutely confirmed this to us, is effectively they take the rough with the smooth. So they'll take the 31 BMIs with then the people who are healthier, and then they just have to say, right, where is that line in the middle where we can basically price the same for everyone? Knowing that, suddenly I'm actually a bit miffed. But if I had a standard premium, because I'm effectively overpaying for the copy of me that does sit on the sofa every day, eating pizza in that example. So how does that look? So this is actually a real case example that one of my advisors did, and actually then it got submitted to Vitality, and it's actually going in force this week. So clients were 61 years old and 60 years old, and the sum assured was £2 million, done it on an index basis because it's, IHT might go up, but they put the flexibility to accept or reject it each year. And you can see there, great news is they were going to use Vitality either way because our standard pricing was coming in second, and that is effectively how anybody else prices, and that was coming at 1999. So they were like, right, Mark, it's coming to Vitality, but I don't know whether the clients should go for optimizer or indexed. Optimizer pricing or standard pricing. But you can see there that the benefit of taking it on an optimized basis meant that they would be paying £540 a month less, which is effectively £6,500 saving per year. So we needed to be able to illustrate to the clients how Optimizer works, and then they can make an educated choice. The advisor went with both solutions to the client, and then they explained the difference, and then the clients would choose. So if you see this slide here, the middle line is effectively what insurers do. So they expect people's risk to go up as they get older because they're more likely to get ill. If it was critical illness cover, they're more likely to die if it's life cover or whole of life. So what they do is they overcharge us today, even though our risk is lower right now, because they expect it to go up over time. And that's how the standard pricing works, again, with us as well. Optimizer, Vitality are effectively taking a leap of faith on us. They're saying, do you know what? If you are fit and healthy, we can actually drop your premiums by £540 a month. And that is what this graph is showing. So the discount is applied initially, but you need to be fit and active and healthy to actually be able to be profitable for us at that premium. Great thing is we know a client that is looking after themselves on average lives 5 years longer than a client who doesn't. So that is why ultimately the optimizer comes in cheaper, because if we think we're going to get the premiums for 5 years extra, that kind of equals out the discount. But then your clients live more years and more years in good health, so it's quite a good outcome for everyone. So if we have a look at this, how it works is it's actually the world's largest health and wellness program. Over 40 million clients are Vitality members worldwide. And effectively, the more you engage in the program, the lower your premiums increase each year. So if you do nothing at all and just have this policy on an optimized basis and just leave it as it is, it will go up by 2.5% a year. But you can see there, actually, if you can reach the highest Vitality status, that premium will stay exactly the same every single year for the length of the policy. If these clients were expected to live 30 more years, that's a saving of almost £200,000. And actually, if you look at what needs to be done to reach those statuses, it actually isn't hard at all. We're not going to go into that today in too much detail, but super, super high level, you can reach silver if you do an annual health check. And you can actually reach platinum if you do an annual health check, confirm you do a couple other good things like go to the dentist, maybe get an eye test. And actually, if you do 4 days of activity between you, so that could be life one doing all 4 days, life two doing 0, or it could be two each. Activities, just go for a nice long walk or maybe a workout or whatever it might be. But yeah, 2 days a week of activity and a health check, then they can actually reach the highest Vitality status. If we go to the next slide, you'll see actually 2/3 of the UK population would reach at least gold status, which means it would never catch up to the standard premium. And that's just based on what they do today. You know, COVID was so awful for so many reasons, but I guess one of the few positives was actually clients and, you know, just the UK population in general are more aware of their health and well-being than they have been prior to it. So actually people do want to look after themselves. They do want to live more years in good health. So they're already doing more than enough to benefit and actually reach the higher price, higher vitality statuses. So they might as well take the massive discount up front because it's never going to catch the standard price. And interestingly, our highest engaged age range is the over 50s. And I think that is basically because they become more aware about their health as they get older because they see their friends and family have problems and they don't want that to happen to them. So they're more health conscious. So ultimately, in this example, advisor went back to the client with both options and explained how the points program worked because we hopped on a call and went through that in a little bit more detail. And the client had to make a decision. To make that easier, though, we then have another tool, which again we will send out to you in a follow-up, but you can actually get the URL here, which is it's just premiumcomparison.co.uk. And what it allows us to do is put in the age next birthday of both clients. So it was 62 next birthday for life one and 61 for life two. Can then put in the optimized price on the left-hand side, and then you put in the standard price. You know, if Vitality wasn't coming in second and say it was another provider, you could put in their premium there. You then press compare, and what it will do is it will tell us how many years a client would be better off having an optimizer versus standard. And you can see that even if they did absolutely nothing, it's ages 87 and 86 before they would be worse off in terms of cumulative premiums paid into the policy. And that is actually past their life expectancy. So that already sounds good. But as long as they do one health check a year and just reach silver status, they wouldn't pay more even if they reached age 100. So actually what we tend to find is once advisors understand this, 10 out of 10 policies are indexed and probably 9 out of 10 policies are optimized because the discounts are so large that you just don't really ever see it catch up as long as you're willing to do at least a health check. So that's kind of a bit of a high level overview of how it works. I hope that makes sense. What I would implore you guys to do is actually, you know, reach out to your individual business consultants who looks after you. And what we can do is we can hop on sessions with you, show you how to position this with cash flow modeling, for example, because that is amazing as a sales aide to do it that way with clients and do that sort of thing. But yeah, just to kind of recap before I hand back over to Becky for the Q&A, the opportunity is absolutely massive. The IHT bills are going up year on year on year. Wait until pensions are included in 2027. It's going to skyrocket. That is why clients are hyper aware about IHT now compared to previously. The premiums are the best pricing that they've been. You know, it says in the last 5 years, but actually I've been at Vitality for 9 years and I've not seen them as good as what they are currently. And obviously, indexing it is a complete no-brainer because it gives that upfront discount. And then not to blow our own trumpets too much, but we do offer really, really good support. We can do one-to-ones with you, come out to see you face to face, go through this in as much detail as you need. So you feel super confident to go and deliver this to clients. And, you know, I always describe ourselves, so business consultants, we're kind of like magpies in the fact that we will take the shiny good things that we hear other advisors do well. And we might say, okay, so how did you do that? Well, why did the clients take this? How have you written 10 whole of lives this year? And we kind of hear the good things and we get able to then share that with others. So use us. And then we've got people like Gary who are, you know, technical support is A1. And then we've also got trust and tax people as well that we can go to. But yeah, that's pretty much everything.
Marvelous. Thanks, Guy.